After collapsing from 5.1% on March 8th to 3.77% on March 24th, U.S. two-year yields have traded in a fairly tight range, roughly defined by 3.8% on the downside and 4.2% on the upside. Now, the timing of the initial move lower corresponded with those headlines of bank stress that many analysts still feel exists. Two-year directional calm seems to reflect the potential bank problems juxtaposed against economic data that has remained fairly strong, despite many calls for a coming recession. Now, it appears that the market believes that the Fed's tightening cycle is probably done. The futures market currently has a probability of 17% for another 25 basis point hike at the June 14th meeting. But it's also pricing in 50 basis points of easing from current levels by the end of the year. Now, that's according to the CME FedWatch tool. The Fed has several critical data points to assess before their next decision, with payroll numbers on June 2nd and then CPI and PPI on June 13th and 14th. Any one of those numbers has the potential to dramatically shift Fed expectations and short-term yields. Now, if a trader believes that yields could head higher from here, they could express that by buying the May micro two-year Treasury yield futures contract at 4.02 and targeting a move back to the November highs of 4.70. A stop for this trade could be placed below at 3.52. This trade could make $680 if the target is reached and risks $500 if you're stopped out of your level. Now, if a trader believes that yields could move to the lower end of the recent congestion, they could express that by selling the May micro two-year Treasury yield futures contract at 4.02 and targeting a move back to the March lows of 3.77. A stop for this trade could be placed above at 4.20. This trade could make $250 if the target is reached and risks $180 if you're stopped out of your level.